All right, we're looking at some gains here. My car makers are up. Broadcom is up. It's an exciting market on this Friday morning. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
The chips are up. Semiconductor shares getting a boost from Broadcom's bullish outlook on AI demand. And it's not just AI excitement. Wall Street is looking ahead to the final Fed decision of the year. We'll get the view from Morgan Stanley's top strategist, Mike Wilson. Plus, salt is back on the table, just not as much as we had before Donald Trump. His advisors considering doubling the state and local tax deduction from $10,000 to $20,000. Let's take a look at where markets are trading right now. As you saw, futures gaining about 1/3% on the S&P. We're down for the week. I think we're off about 2/3% for the week. So this won't take us to positive. It'll be the first down week in 4. The NASDAQ is doing better than the S&P as the chip stocks move higher. You can see it's up 0.75% in terms of futures. And there's not a lot of movement in the bond market. We're up 2 basis points, but now we're at 435. And just a couple of days ago, we were under 420. So
that's true. It's been a real stealth climb when it comes to the long end of the yield curve. But let's take a look at the equity market and what's moving before the bell, because Broadcom shares absolutely soaring right now. That's after they reported earnings and predicted a 65% increase in sales of AI products in the fiscal first quarter. Shares up almost 18%. Then you take a look at Affirm, just some breaking news now about a deal with Sixth Street worth $4 billion of consumer loans. That's its largest capital commitment to date. That's worth about 5.5% higher on Affirm holdings. And then you take a look at RH. This is a really interesting one. RH raising its 2025 revenue forecast, also saying that potential tariffs won't have a negative impact on margins. We've certainly heard something different from other companies in that space. So RH up about 13%. That's the micro. Let's talk about the macro and wander back over to the desk right now, because you think about the year ahead. I loved this note from Chris Harvey over at Wells Fargo, Matt, basically talking about how there's a lot of shy bulls out there that just want to be contrarian right now.
Well, and we have a tear from his note. He says, our post-2025 outlook discussions imply there are many shy bulls. Some PMs claim to be bearish, but are driven more by the desire to be contrarian than by fundamentals.
I can sympathize with that.
Well, the thing is, he says some PMs claim to be bearish.
Yeah.
But they haven't been coming on this show.
There's some quote out there. The sentiment has been said many times before that you say bearish things to sound smart. They always sound smart, but then you take a look in the grand fullness of time, it just feels like stocks always go up. So you can sound smart, but you can also be wrong.
I mean, in the grand scale of time, stocks do go up. The problem is what happens next year or in 5 years. Joining us here at the table is Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. You know, people think of you as a bear also, Mike.
And also very smart, so.
But you're not really bearish this market, are you?
Well, no, we haven't been for the better part of 6 or 8 months. We took our targets up significantly in May, sort of in the idea that we were going to kind of make it through. There wasn't going to be a growth scare that it caused a hard landing. And also the Fed, the Fed moved 50 basis points. And then, of course, we had the election outcome. So, we've had a lot of good things that have happened over the course of the last 3 or 4 months. So I would argue the markets have traded that really, really well as they typically get ahead of those things. The question now, and I think we said on this program in October, we said we think we could trade 6,100 on a definitive election outcome, and we got that. So now here we are at 6,100. Do we just revise our numbers higher? No, we think we're on track for 6,500 by end of next year, assuming that things progress the way that we expect, meaning the base case assumptions we have for our economic forecast for the Fed. That's where the sort of risk is that our forecast on the outcome is not what we expect it to be. And I think this year's next 12 months is going to be just like the last 12 months, where there's uncertainty at times around the growth outcome and the inflation outcome. And
but up 30%.
Well, not up 30, but I mean, the thing is, the last 12 months, we got the earnings forecast exactly right. What we got underestimated was the multiple. And I don't think I was alone in that. I don't recall anyone telling me we were going to trade 22 or 23 times. But then when we get there, everyone just justifies it and says it's okay. We can stay here or even go higher. So look, markets are a little bit diabolical. They trade ahead. And when you're trading the stock market or stocks, you need to think about what's going to be happening in 6 months, not what's happening today. And I think the first half of next year is where the uncertainty probably is going to increase. And then by the second half of next year, things could clear. So it's going to be another, I think, volatile year, plenty of trading opportunity, plenty of dispersion in the stock market. That's what we kind of focus on, what to own, not how much to own. And that's the game. That's the game that we play.
Well, let's talk through some of that volatility, because there's the absolute level, right? 6,500 year-end 2025. It feels like a lot of Wall Street has coalesced around that number. But what does the path to get there look like? What do you see the road being over the next 12 months? So
that assumes that the economy stays sort of, below trend growth, but healthy, sort of 2% real. Inflation continues to climb down, but not, go in a way where it's deflationary. So you have 4.5% nominal GDP growth, which gets you 10% earnings growth. There'll be some operating leverage, and then the multiple comes down a little bit, but not as much as what we would have thought this year. Because look, that's where we are. It's very hard to get the multiple to come down if the Fed's cutting rates and you have above trend earnings growth, and that's what we're forecasting. Once again, assuming soft landing. Okay, inflation continues to come down, and the Fed can cut. I would say the biggest risk in that outcome is on the inflation side. We're seeing inflation pick up again because, look, let's be honest, financial conditions are very loose again. Some of that's the market itself. We have now animal spirits picking up because the election outcome, and people are excited. That excitement has a negative consequence, which is that all of a sudden inflation starts to pick up again, and maybe the Fed can't cut. That, to me, is probably the biggest risk to the multiple.
That the Fed can't cut.
As much as people are anticipating.
So, and this may be a driver of that, but wouldn't bad certainty on tariffs, bad certainty on mass deportations, wouldn't that be bad news for the economy and for the market?
So, that's, once again, going back to our view for next year, I think the risks are front-end loaded. We're going to get a lot of announcements. Like I would say the bad stuff comes early. The good stuff from the changeover around the administration comes later, meaning, tariffs and immigration.
But you do think we'll get certainty? Because I feel like it's going to be a little bit like Lucy holding the football, Well, we'll see. Donald Trump loves to play that game. He just pulls it away every time you take a kick.
Well, look, the way policy's made is you float trial balloons, you see how the markets react, and then you're reflexive. That's how I anticipate this to go down. And every time you get one of those sort of trial balloons and then policy actually is made, you get more certainty. That doesn't mean the market's going to like it or love it. It just means we're going to get more information as we go through. He hasn't even taken office yet, So let's give it a little chance there to breathe. I would say, once again, I think that the sort of headwinds for the market are probably early policy changes, and then the good stuff, whether it's deregulation, maybe some government efficiency, maybe tax extensions or even further cuts, comes later in the year. So that's the setup for now, all subject to revision, of course, because there's a lot of other things going on as well.
Yeah, a lot of big ifs there. But I do want to talk specifically about this month. You had a really interesting note out a couple days ago talking about how usually in December you see the small caps lead. That's not what we've seen. The Russell 2000 is actually down about 3% over the past 2 weeks, and it's been big tech that's been in charge. So what is different, and do you see us reverting back to some of those historical patterns?
So I think what happened is, and this happens every year, we get the sort of small cap trade earlier and earlier every year. We also had the election, and we know from 2016's experience that we were going to get a big pop in sort of small business confidence. We since confirmed that earlier this week. That was the biggest increase we've seen in 25 years, small business confidence. So maybe the market kind of pre-traded it. I still think the second half of this month, we could see further outperformance from small caps and some cyclicals, just as you kind of mark that up into year end. And then I think you'll get a fade into January, February. That's the way historically the last 4 or 5 years is or 10 years really. You get the small cap trade now earlier, and then you actually fade it at the beginning of the year.
Here's 2 weeks of the major indexes. If you take it out to 5 years, you'll see the Russell 2000 has really underperformed, and the tech stocks, the NASDAQ, has really outperformed. Does that a pattern hold indefinitely? Is this just how it is?
Well, we've had that view for quite a while. When we just finally upgraded small caps this summer to a neutral, we're still neutral on that view. I think right now the market is still going to be, it's somewhat narrow.
You upgraded to a neutral.
We upgraded to a neutral.
We have a viewer writing in who wants to know, what made you change your bearish stance? What was it that made you say, okay, you know what, I'm throwing in the towel, we're bold up?
Well, I mean, the data. I mean, basically, I think it was pretty consensus a year and a half ago that the Fed's hiking regime was going to lead to a hard landing, and it never arrived. And there are a lot of, we can go into we wrote a long note about what was different this cycle. Now, to be clear, I don't think the risk of a hard landing has been extinguished. And we're still late cycle, which is why we're trading narrow again. We're trading, people are going for the large cap quality stocks, which is why we don't want to go full overweight on small caps or low quality. We don't think this is the part of the cycle. We're not of the view that this is going to be some big ramp in the next year, that everything's changed, right? It's still a late cycle economy. Rates are still pretty high. Mm-hmm. We have cost issues with some of the smaller businesses. Most consumers are still struggling. Okay, that's not a kind of environment where small caps or low quality stocks tend to outperform. The one last thing I'll say, though, which is I think a big thing that people misunderstand, is that most stocks, okay, not the big stocks, most stocks do better when inflation is actually accelerating. So if you go back and look at like 2020, 21, and even in 22, the average stock did better than the S&P 500 when inflation was actually accelerating.
Makes sense, though. You want to hold stocks to hedge inflation, right?
And earnings growth is better. So I do think that next year what could happen is we could have a correction in the first half of next year as perhaps inflation comes back. But that's an S&P event. And actually the average stock may not go down that much. That is an interesting kind of relative value trade that I think people who can do that should be thinking about right now.
Interesting. So maybe a little bit cautious when it comes to the benchmark, but still opportunities to find at the single stock level in that scenario. But I do want to get your thoughts on how the different asset classes are talking to each other, because the bond market has been so volatile, especially if you take a look at the long end. Feels like the stock market, maybe some enthusiasm coming out, but it doesn't necessarily seem to be rates driven. How do you see that relationship evolving in 2025, especially if that big risk comes to fruition and the Fed can't cut as much as expected?
So the rate correlation with equities has flip-flopped quite a bit. And earlier this year, it was quite negative, meaning when rates went up, it was bad for stocks. And now, really since the fall, that's why we pivoted more cyclically. Stocks are now positively correlated to rates. And we think the sweet spot for 10-year yields is 4 to 4.5%. Like in that range, stocks can actually act okay, like as rates go higher. If we get through 4.5, and if term premium starts to increase, which would be concern about inflation, then you're going to see that correlation flip again. So we're, like everybody else, we watch how markets are reacting. It's very reflexive. But we think, once again, that 4 to 4.5% range is kind of a sweet spot.
All right, Mike, it is always great to speak with you, especially on a Friday. Have a great weekend.
Friday the 13th, no less.
Very,
That's right.
Very spooky. It's great to see you.
Thank you.
That is Mike Wilson. He is Chief U.S. Equity Strategist. Now, coming up, it is a big boom for Broadcom. Shares of the stock absolutely flying right now after delivering a bullish outlook. More details next. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. French President Emmanuel Macron is picking Francois Bayrou to be the country's new prime minister, calling on a longstanding centrist ally to navigate a fractured political landscape that toppled the last administration. Bayrou must quickly rewrite fiscal plans with concessions to gain support from Macron's political adversaries. Investors are watching closely after months of political upheaval sparked a sell-off in French assets. And Elon Musk is trying to turn the Starbase site in Texas into a new city and officially move SpaceX's headquarters there. The company's headquarters are currently in California, but it's been building out a massive facility on the southern tip of Texas near the Mexican border. There are several steps that need to occur before Starbase can actually be created as a new city, including permission from local authorities. I feel pretty confident he can get that. Now, it's not a bird or a plane or an Iranian mothership, but officials still don't know exactly what's behind sightings of car and bus-sized drones flying over New Jersey. The drones have been spotted hovering above critical infrastructure like water reservoirs, rail stations, and police departments. The Pentagon says there's no evidence the activities are coming from a foreign entity. they really don't know what's going on. The White House says the drones are legally operated. Do they know what's going on? Some residents are taking matters into their own hands to uncover the truth. A Facebook group called New Jersey Mystery Drones has amassed nearly 32,000 members. Katie, have you seen one?
I haven't seen one. I have a ton of theories that I won't share on air, especially because we have to pivot now. We have to talk about Broadcom because the stock absolutely surging. That's after it predicted a boom in demand for its AI chips last night. The company expects the addressable market for AI components to reach $90 billion by fiscal 2027. And here with more is Mandeep Singh of Bloomberg Intelligence. I feel like there's two takeaways here. One, that AI spending is alive and well, and two, that Broadcom is a big beneficiary of that. Boy, it's Friday.
And also, when you look at where this $60 to $90 billion number is coming from, it's coming from 3 customers.
Yeah.
So when NVIDIA says they have hyperscale exposure, about 40 to 45% from hyperscale customers, in this case, Broadcom's entire revenue is coming from 3 customers, and 2 are common across Broadcom and NVIDIA. Google and Meta are common customers. So really, the other inference I would draw from this is CapEx is going up. The consensus CapEx numbers for Google, Meta, Microsoft are way too low.
Can we just talk more about the fact that it is so concentrated, that customer base? Because you don't see really any worry about that in the shares. But like you say, they have some customers in common, a lot of these chip companies. And I have to imagine that some of those big tech companies who are spending all this money have thoughts about bringing this in-house.
Yeah, and this is the way to bring it in-house. So what Google is doing with TPUs is they are using Broadcom to build their next 1 million cluster. And just to put it in context, it's almost 10 times the current biggest cluster, which is 100,000. So clearly, the scaling laws will continue to be applicable when it comes to AI. And a lot of these customers, Meta, it looks like they may bring it in-house if they are a big spender on Broadcom chips. Then you don't need to buy as many chips from NVIDIA. And that is the part that is still in flux because no one knows if they will continue to scale up on NVIDIA architecture or they'll build their own, which is what Google has done. And they have shown that. Amazon hinted at that. But I think now it's becoming more clearer that every hyperscaler wants to scale using their own chips.
I have looked at the stock, and it's doing better than all of the other Mag 7 stocks, with the exception of NVIDIA and Tesla. So Broadcom is up total return like 564% or something over the last 5 years. We probably have a chart that would show it perfectly. In any case, that said, $90 billion in an addressable market 2 years from now doesn't sound like very much. That's half of General Motors' revenue, and they're like a 100-year-old car-making company.
Well, so it's $90 billion just from these 3 customers, which are currently, the addressable market from them is 15 to 20 billion. So the fact that these 3 customers could become 3 to 5x in terms of their spend, and look, there could be potentially Apple and OpenAI. Those could be 2 new customers in terms of the data center spend. But, the customer base is very concentrated, and it just goes to show that, Apple hasn't really spent a lot on CapEx so far on NVIDIA GPUs. Well, guess what? They may end up building their own silicon on the data center side, and they will end up using Broadcom.
Is there any urgency among these companies that you can sense to onboard new customers, to get new big sources of spend? Because you think about Broadcom in particular, forecasting sales of AI products gaining 65% just in the fiscal first quarter. Is that just a single customer?
Yeah, think of, TSMC's proposition. It's a foundry of the world. Everyone goes to TSMC because they're the kind of the most neutral player when it comes to manufacturing this. Broadcom could be the same way for hyperscalers. All the hyperscalers could come to Broadcom for their connectivity and their custom GPUs or their custom chips, and they don't need to rely on NVIDIA. And that's where I think their pitch is that you can customize the chip according to the workloads. The fact that AI needs 1 million clusters, it just tells you that AI is a scale problem. But you can solve that scale problem using a Broadcom, which is a neutral customer. It will never compete against the likes of Google or Microsoft or Apple that are deploying this for their applications, whereas NVIDIA could be a potential competitor down the line.
All right, Mandeep, really appreciate the breakdown, making sense of what's going on in Broadcom shares, absolutely soaring right now. That is Mandeep Singh of Bloomberg Intelligence. Let's show Broadcom pre-market once more, because the stock was already up bigly this year by more than 60%, adding another 19% pre-market, set to open at an all-time high. So AI optimism clearly alive and well, Matt.
Yeah, I mean, I think it's absolutely fascinating. And don't forget that Broadcom isn't the only potential competitor to NVIDIA. So there are a number of other
AMD.
smaller businesses,
Yeah.
that say they have chips, designs ready to make that are just as good. So we'll continue to focus on Broadcom for sure. Coming up in the next hour, we're going to dive more into the tech trade with DoubleLine Deputy CIO Jeff Sherman. And we're going to ask Jeff, what's the deal with those drones? Do you think he has a theory?
I don't know. He's in California.
Apparently dozens, even hundreds of drones over New Jersey that the White House says, like, please disperse. There is nothing to see here.
I bet he could come up with some great theories on the fly, but I don't think that man thinks about New Jersey. But we'll ask him. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. A quick check on futures here. We have some green on the screen finally. If you take a look at the S&P 500, up about 0.2%, even better on big tech. The Nasdaq 100 up about 0.6%. The small caps not really feeling a lot of the love right now, down about 0.1%. It's actually been a brutal month so far for the small caps, even though seasonality tends to benefit the little guys in December. We'll see if that changes. But coming up, less than 4 minutes until the opening bell, we'll discuss the market moves and so much more with Evans May managing partner Brooke May. That conversation up next. This is Bloomberg.
Futures are higher, at least for the big guys. Moments away until the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You can see that we're looking at gains on S&P futures, gains on NASDAQ futures. Russell 2000 futures are down, and they've had a rough month thus far, although as Katie and Mike Wilson point out, seasonality is good for the Russell in December. You hear the opening bell ringing down the New York Stock Exchange. Timken, they're apparently innovating for tomorrow, and C.H. Robinson down at the NASDAQ market site. Now, it is still set to be a down week, and if we don't move up much higher, it'll be the first losing week in 4, but maybe we can get there by the end of the session. Katie Greifeld, what does it look like right now?
It's certainly possible. A lot can happen between 9:30 and 4 p.m. as we learn every single day. And you take a look at this setup right now on this Friday the 13th. You can see the S&P 500 currently up about 0.3%. Like Matt said, heading into today, the S&P 500 is down about 0.6% for the week. That would be the first down week in several, so we'll see what happens. Big tech currently in charge. The Nasdaq 100 up about 0.9%. We know Broadcom popping off right now has to be lifting that benchmark. The small caps, they had a rough day yesterday. They're having a not so nice day today. We already flipped up, but the Russell 2000 down about 0.2% right now. Now we'll get to Broadcom. Of course, you can see that shares are soaring right now, chasing all-time highs. It reported earnings last night, anticipating sales of AI products to jump 65% in the first quarter alone. AI revenue also grew 220% during the year. So you add it all together, shares are soaring. This is now a $1 trillion company. We're also keeping an eye on shares of Affirm because shares soaring after inking a deal worth $4 billion in consumer loans with 6th Street. That puts Affirm's loan originations over the next 3 years at over $20 billion. That's good for the stock because shares currently up about 4.6%, Matt.
All right, all interesting stuff, but we've really been focused on furniture this morning. Restoration Hardware is surging to the highest level in almost 3 years. It raised its 2025 outlook, saying tariffs would not negatively impact margins if implemented. And we want to take a closer look at the whole group, as well as RH with Bloomberg's Abigail Deuler. Abby, what do you got?
Well, Matt, let's really dig in on RH first, because it was a great quarter that they put up. They swung to a profit for November. The RH brand in particular, the demand was up 25% 24%. Right now, December tracking up 30%. So some real strength there. And as you mentioned, they boosted the view. They're now looking at sales of up 6.8% to 7.2%, better than what had been. So the strength that they've been seeing in November and December, they think that it is going to play out for the rest of this year, although the fiscal year 2025 for them does end relatively soon. But nonetheless, investors loving this. The stock up 30% on the year. This is pretty in line, though, and I should say into today's big boom with the rest of the retail space. What we're looking at here is the S&P 500 Consumer Discretionary Index in white, up about 36%, and then staples this year up about 35%. The best year, up 17%. The best year since 2019. So really some consumer strength there. The S&P 500 right in the middle, up more than 25% strength any way you slice and dice it. But Katie, we of course have this bifurcated consumer, and it's really interesting because RH, of course, is a super high-end furniture, but so does Ethan Allen. Take a look at RH on the year now with today's gain up close to 55%, whereas Ethan Allen down on the year. RH booming along. Ethan Allen had a couple of misses. They both have pretty high short interest, but it seems like those bears are winning just a little bit more on Ethan Allen. RH, one of today's big winners, and on the year, too.
All right, Abigail Doolittle, thank you so much. I think
no mention of Lovesac.
I knew
no
that
mention of Wayfair.
We all knew you were going there.
Yeah.
So, but yeah, it is interesting because Wayfair, I think they're doing a little bit better. Or no, actually, they're doing terribly for the year. And you compare that to RH. And like Abigail was saying, it's really hard to talk about the consumer as a monolith right now. Everything feels so company specific, so C-suite specific, that it's hard to really paint with a broad brush when it comes to some of these names that are even within the same sector. But
I'm just pulling up the comp screen. You know, I like a solid 5-year period, and Wayfair is down 40% over the past 5 years, whereas Restoration Hardware has doubled. I will reiterate Lovesac, though, because I absolutely
even though it's a tiny company.
I know it's a small company, but it's a hilarious name, and the stock has done really well, better than those other two, up 133%. It had a tough day yesterday. It fell like 24% after a bad outlook, but they make giant couches that are a little bit too extravagant for my wife's taste, and they have built-in subwoofers.
That's nice. Do they have, like, you know, I can really put my drink down and
if you put your drink down, it'll charge.
Okay, great.
Wirelessly.
Beautiful.
Yeah.
There we go. There's the 5-year look. 130% or so. Matt, of course, is all bold up there. Let's broaden out this conversation now with Evans May Wealth Managing Partner Brooke May. And Brooke, I want to come to you on the consumer, the conversation we were just having. I won't ask you about Lovesac specifically, but you look even within a single sector, a single industry, and there's big dispersion at this point in the year. What do you make of that when you're trying to evaluate this market?
It makes it difficult. And as we know, the S&P 500 is predominantly driven by the top 7 names. And so whenever we talk about the direction of the index, it's going to really lead with big tech and AI. However, there is a dispersion right now between earnings, and all companies aren't created equally. So you really have to look at where the earnings growth is, specific not just to industries, but also to individual companies.
So, you know, we were told that the consumer was waiting, that businesses were waiting for the election for certainty on purchases and orders. But we still don't really have that, right, Brooke? Because even if I look at something as seemingly silly as the furniture makers, tariffs really matter. And we need to know what they're going to be before we buy those stocks for next year.
We couldn't agree more. When we look right now at the Fed, there's a 96% probability that they're going to cut rates next week, but we fully expect them to pause in January. And we think that pause is going to be also correlated to the fact that they're going to wait and see what the Trump administration wants to do and if those policies are inflationary. It's scary, 60% tariffs on Chinese goods. When we look at the U.S. economy, we're very dependent on those imports. And during the first term, a lot of those increases in tariffs were absorbed by the manufacturers. And that won't happen this time around, at least not to the full extent. So I think that the Fed will partially pause just to see if tariffs are implemented or whether we're going to see just some symbolic tariffs and then some negotiation after that.
I want to dial in on the Fed here. Of course, we're counting down to their meeting next week. We were just having a conversation with Mike Wilson, who said one of the biggest risks for 2025 is that the Fed can't deliver the rate cuts that the market is expecting. And if we do get that pause, starting in January. Do you think that the market is prepared for it at this point?
The market has done very well, clearly, and we're optimistic going into next year. Our price target is in line with Mike Wilson's at 6,500. That said, we think that there's really quite a bit that can happen between now and then. And so we're going to just wait and see what the data has in store for us and then go from there.
What about alternatives to stocks? Is there any alternative to U.S. stocks? Do you like other regions?
We don't. Right now, internationally is trading at a discount, but it always trades at a discount. And we feel like that discount is warranted. We think that the best risk to return right now. At some point, the discount, Brooke, must get too deep, right? At some point, EM falls off so much that it's too cheap to ignore. We still think it's the best risk to return. Yes, you can make money in EM, but there's a lot of factors at play right now. Tariffs, for example, in addition to other factors. And so we continue to like US. We're equity biased. Most of our portfolios are equities. We don't use a lot of alternatives because we think that over time, that's where you're going to make the most money. And right now, we're overweight significantly to the US.
That's interesting. I mean, is there anything that would change that setup from you, either when it comes to the U.S. side of things or maybe the rest of the world side of things?
Absolutely. Absolutely. If we were to see some bifurcation and the U.S. started to struggle, however, foreign markets were doing better and foreign economies were doing better, we absolutely would shift. But right now, we think that the U.S. is the best game in town.
We have the Fed next week, Brooke. And of course, we're dialing back our expectations for the cuts in 2025. I think everyone's on board that there will be a cut December 18th. But how important is the Fed to this market? Is it taking a back seat to things like economic growth, to things like tariffs?
We're at a point now where rates aren't necessarily crippling. And whenever we look at other factors at play, we think that really CEO sentiment right now is a factor that we're focusing on more than usual. And when we looked pre-election, CEO sentiment was stable, but not overly optimistic. And we think the next read, there's going to be a shift to more optimism. And CEOs are the ones making the decisions on hiring, firing, and also spending from a corporate standpoint. And there's a lot to feel good about right now if you're a business. We likely will see lower corporate tax rates. We're going to see probably some deregulation. And we've seen hiring conditions improve. So all that, in addition to spending, right now we think that businesses are going to increase their spending on CapEx and R&D, maybe 7 to 8% next year. We expect share buyback spending to be up 20% and dividend spending to be up about 7%. That's a good environment to be an investor.
Brooke, great to get some time with you. Hopefully we get you here in the office soon. Brooke May there, Evans May Wealth Managing Partner. Coming up, we're going to take a look at which cars revved our engines in 2024. I did not write that pun.
Are you sure?
But I read it. And which got stuck on the side of the road. Hannah Elliott joins us from the podcast Hot Pursuit. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, two paws up for General Mills. The food giant is getting upgraded to a buy over at Bank of America. The firm expects General Mills to return to growth at a faster rate thanks to a re-acceleration in pet food demand. Next up, we have JP Morgan cutting its outlook on home builders. The firm downgrading D.R. Horton to a sell. The analyst sees a much less supportive demand and supply backdrop for the industry and expects that D.R. Horton will underperform over the next year because of its expensive valuation. JP Morgan also cutting Toll Brothers and Meritage Homes. And finally, Goldman Sachs is initiating coverage of e.l.f. Beauty with a buy rating. The firm sees growth potential thanks to the company's innovation and its convergence with the health and wellness industry. The analyst says, quote, e.l.f. is one of the most disruptive players in beauty. Matt Miller.
Yeah, I have felt the same way ever since. Actually, one time I talked to a woman who was driving a car for e.l.f., and I thought it was e.l.f. Aquitaine.
Interesting.
at the Indy 500, and it was actually eyes, lips, face.
What a nice segue.
Yeah. Yeah, it is a good segue into the auto industry. It's been a hectic year for a lot of the car makers across the globe. They had to make adjustments due to economic and geopolitical volatility. Plus, they spent all this money investing in EVs, and now nobody wants an EV. But we saw manual transmissions make a resurgence, thank God. And here to talk about the year that was is Bloomberg's Hannah Elliott. She is my co-host on the podcast Hot Pursuit. And also a lover of, well, you like more luxurious, more expensive cars than I do.
Sure, I've been accused of being a snob, but I'll take it.
So,
I've been called worse.
So you have a list out of your best cars of the year, and you've had amazing driving experiences, climbing up a mountain in an off-road Porsche and driving around Villa d'Este or whatever you call it in Italy in very expensive collector cars. What was the best experience for you this year?
Well, this may or may not surprise you, but my favorite car that I drove was the Ferrari 12 Cilindri, which is Italian for 12-cylinder. And I love this car because it's really polarizing. It is kind of a throwback to early Ferraris, like you might see a little bit of a Ferrari Daytona in the front, but it has a 12-cylinder engine, which is increasingly rare, but it's still really noticeably, obviously, a Ferrari. It just drives amazing, a top speed of 211 miles per hour, more than 800 horsepower. A good combination inside of, there are some really advanced screens, but there are also some buttons and knobs that I still like to be able to work when I'm inside. So a really nice combination of everything.
And an interesting tactile experience, it sounds like.
Exactly, which is key. I personally, I love a screen, but I also want buttons and knobs, and the 12-cylinder Ferrari really combined all of those nice things.
So I can't relate to either of you because I haven't touched a lot of these cars and probably never will. But
you have a good car.
I do have a good car. I drive a Genesis.
Cool.
It's
GV70.
Amazing.
Got very good reviews.
Yeah, it's pretty nice. I love the grill. But I also do love trucks. And you also have a truck on this list. So let's talk about it.
Yeah, so this Ford F-250 King Ranch, it's about $75,000, which is actually pretty affordable for some of the bigger, nice trucks. I mean, usually they're over $100,000.
And it's the diesel, right?
And it's the diesel, which, again, I love. And maybe we're sounding a little bit old world in this age of EVs. I'm talking about a 12-cylinder and a diesel engine. But I just love it. It's completely functional. It can tow more than 40,000 pounds, but inside feels really luxurious. It's got all of this cool King Ranch stitching. King Ranch, as you know, is an actual ranch. It's a place. And I just kind of like great visibility, very comfortable, rugged, but it's got some nice touches for those of us who like the finer things in life.
Over 1,000 pound-feet of torque.
That's
Yeah, I think
that sounds like a lot.
It'll hammer down. I mean, even Matt would love that truck.
I definitely do. I want to show you a couple charts.
Please.
First off is Ferrari versus the rest of the luxury manufacturers, or what I would put in there. So I put Volkswagen because, you know, they own Lamborghini and Porsche. Well, Porsche is its own stock now, and that's what I want to ask about. But we put Mercedes and BMW. Ferrari is doing the best of all of these since Porsche started trading. Porsche's doing the worst. And this company has some of the most amazing margins of any car maker in history.
Yes.
And it makes cars that we all love and want.
Yes.
What's the problem?
Porsche is at a really interesting time. It has had a decade of dominance, and now is going through a real sort of maybe philosophical struggle about where it's headed with electric vehicles. And I think that is causing a ripple effect throughout the rest of the company. Let's not forget EVs have really been a challenge for VW, which still owns Porsche, controls Porsche in a way. And that is affecting a lot of Porsche's production, delivery discipline. It's having a ripple effect, and I think maybe that's what we're seeing in this chart. Ferrari has not felt in the same way. And let's talk. I mean, Ferrari has far smaller volume, so it's a different animal.
And even higher margins.
Completely.
By the way, we were showing the company video of the presentation for the GT-S, which Hannah drove in, I believe, somewhere exotic in Spain.
Yes.
And it had like a hybrid turbocharger and gearbox. It's all very complicated.
Sounds very fancy and complicated.
It's fancy, and it's interesting that Porsche is really trying to hold back the 911 from going fully electric. It's the hybrid's a concession, but no full EV yet for the 911.
All right. It's unfortunately all that we have time for.
I know. We didn't even get to ask about what you hated, but we'll have to
tell
have
you-
you back.
But I'll tell you what, the good news there is we
good.
actually made a podcast
I've heard
episode
about this.
that.
Yeah.
So
You know, you should come on and talk about your Genesis.
I have some things to say. I don't know.
We'd love to hear if you have pet peeves. I love a good pet
she
peeve.
has electric truck experience.
I do.
So she's
Cybertruck?
driven.
Not the Cybertruck.
Okay.
I'm a little bit obsessed with it. I feel like maybe you don't like it.
No, it was actually better than I thought it was. That's another thing that I drove this year. I actually loved that little kids come up to that truck and love it.
Yeah.
You know, anything that
Well,
gets
it
people
looks
excited.
like a child drew it, and then it became a real life truck. So that makes sense that they would like
and
it.
it also reminds me a little bit of the DeLorean from the 80s, you know, from Back to
Yes.
the Future.
The
It's got that
stainless
same stainless steel, flat lines. There's something that it's nice when cars make people feel something.
Yeah.
Maybe they make you feel hatred.
Yeah.
But, you know, at least they have some sort of emotional response.
It makes me feel mirth and joy. It also looks like it would get very hot in the sun. But why don't you promo your podcast?
I will promo. Well, first I'll say Tesla hit an all-time high in terms of its stock just a couple days ago. And you should check out our podcast. It's called Hot Pursuit. I host it with Hannah Elliott every week. A new episode coming out today with McKeel Haggerty. Now, coming up, Trump vowed to bring back the state and local tax deduction, or remove the cap, is what I should say. And now they're talking about going halfway. Is it his first broken promise? That's next in our Wall Street Beat. This is Bloomberg. Time now for the Wall Street Beat. Donald Trump plans to bring back some of the state and local tax deduction. His economic advisors are considering doubling the deduction limit from $10,000 to $20,000, but still capping it. Now, you used to be able to write off your state and local taxes from your federal. That was just how the system worked until 2017 when Trump and the Republicans capped it at $10,000. Then, campaigning this year, Donald Trump came to Long Island and said he would bring SALT back. It doesn't look like they're really going to do it. Bloomberg's Stephanie Lai covers the Trump transition and joins us now. So, Stephanie, I think the president led everyone in New York to believe that he was going to bring the SALT deduction back, and now they're going to go a little bit of the way, but not really do it. Why?
Well, when we look back at his Truth Social, where he announced that he wanted to bring SALT back, that's really all he said. You know, he never really specified with any real specificity in terms of what that would mean. And so when I was speaking with some economic advisors, they had said that, you know, what they're considering right now is a partial, an increase to double it. And part of that is because in order to enact his tax agenda, there's going to be a lot of offsets needed. And if we were to get rid of SALT entirely, that would lead to a massive increase in what we'd need to find extra money for to make up for this lost revenue.
Do you expect anyone in Congress to fight them on this? Because the idea was to go back to the way it was before he put a cap on SALT, which was that everyone could write off state and local tax deductions.
You know, even if it's not an entire change to the system, it is sort of a step forward for some of these vulnerable Republicans and also for Democrats who want to see change. Doubling the cap enables middle-class families to write off more of their taxes. And so with this slim majority in the House, it does seem like this could move the ball in a way.
All right, Stephanie, an ongoing conversation. I'm sure we'll have you back soon. That is Stephanie Lai. Now, coming up in the next hour, Maddi Dessner from Capital Group, as well as Jeff Sherman of DoubleLine. All that and more coming up. This is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and coming up, down for the week, but still, Wall Street set to close out the week on a positive note as Broadcom's bullish outlook lifts chip stocks. Up next, investors look ahead to the final Fed decision of the year. We'll walk through it with Jeffrey Sherman. He is DoubleLine's deputy CIO and cracks in the diamond industry. The CEO of online jeweler Angara tells us how he's navigating one of the industry's deepest slumps. All that and more coming up, but let's take a look at these markets. Like Matt said, 30 minutes into the trade on this Friday the 13th. We do have green on the screen. The S&P 500 up by about 0.3%. That isn't quite enough to get us to a positive week, but regardless, nice to see some green. The NASDAQ 100, of course, leading gains. We had such a bullish outlook from Broadcom. That is lifting the entire benchmark. The NASDAQ 100 up by about 1.2%. And a sell-off underway in the bond market. We were talking about this at the top of the 9 a.m. that it seems like there's been this quiet climb when it comes to the long end of the Treasury curve, and you can see that happening today. The 10-year Treasury yield up about almost 4 basis points.
I'm really digging this music. Anthony, can you turn up the levels just a little bit? I'm so glad we picked this music.
Yeah, it's pretty good.
For the show. It's quite good.
Yeah. Well, we're doing a good job here over at Open Interest, and we're talking through all the important market-moving things that you need to know. And we have a great guest sitting to my left.
Yeah, let's get to Maddi Dessner right now. She joins us here on set, Capital Group, head of global asset class strategy. Sorry, Maddi, I was just the groove in that track.
Yeah, loving it.
Just gets me every time. For some reason, more today. All right, so we're seeing a little bit of a rally after we lost a little bit, right? I don't feel like the animal spirits are really pushing us anymore as much as they were. Now we're really feeling the uncertainty of what's going to happen in Trump 2.0. What's your outlook for 2025?
Well, we just released our outlook a couple of days ago. So the way we think about it, the U.S. is on track for continued expansion, and we expect to see that for multiple years ahead. We've got a strong consumer. We've got easy monetary conditions and loose policy. We've got continuing momentum in the corporate environment in terms of earnings momentum. And so from our perspective, we actually feel like the profile of this economy is a bit more mid-cycle than it is late cycle. So we feel like there's lots of momentum to run. And yes, we're seeing policy uncertainty, but we don't believe that's been priced in. So we're watching that specifically.
Interesting. And you think about all the uncertainty that's out there. Talk specifically about the Fed. Of course, my mind is on next Wednesday, where we know the Fed is going to cut rates. It's pretty much a lock if you take a look at the futures right now and swaps. But what about next year? I'm stuck on this comment from Mike Wilson that that's the biggest risk for him in 2025, that the Fed can't deliver. How are you thinking through that?
Well, our perspective right now, if you look at the inflation print that we saw a couple of days ago, it was a bit stickier than the markets expected. That said, we think this last mile is going to be a bit tough to unseat. So our perspective, absolutely December is a lock in terms of the cut. However, as we see moving into the subsequent year, we think rates are likely to stay a little bit higher than markets expect, and the Fed is probably not going to have as much flexibility to cut, given what we see in terms of financial considerations and corporate earnings and the just overall growth in the economy.
I just don't know if the market really expects as much as it did before anyway from the Fed, right? I mean, we're looking at about 4% priced in at the terminal rate next year.
Yeah.
So the Fed doesn't really have to give us that much more anyway.
No, I think actually what's going to happen is that the markets are going to pivot to focus on policy.
Yeah.
When we have a situation where we've got an incoming administration, we're having conversations about taxes and deregulation and tariffs, the question mark that we're looking at is that going to be stimulative for the economy? Are we going to see earnings growth and economic growth based on that? Or could it be strengthening for the dollar, higher interest rates, higher inflation, and therefore it could stall us a little bit from a growth perspective? So we are playing a little bit more of a step back and wait and see in terms of what we expect in the coming year. That said, one of the things that we are looking at is fiscal policy, right? Our debt to GDP ratios are over 120%, expected to go higher. lots of little changes could change those numbers significantly.
Yeah, don't you think Doge is going to cut $2 trillion in expenses? Also, Scott Bessent wants to take the budget deficit down to 3%.
Perhaps. I mean, from our perspective, as long as the real rate of interest stays above or below the real rate of growth in the economy, the full faith and credit of the U.S. government is strong, and we don't see a significant impact to the level of the dollar or the level of interest rates. But that's a big question for us.
I want to talk a little bit more about what this sort of wait and see stance looks like for you from an allocation perspective, a portfolio construction perspective. Where does that leave you when you take a look at your mix?
Yeah, we actually think there are so many opportunities, though, both in the equities and the fixed income markets today. We are active managers, so we like to look diverse perspectives, look at things from multiple levels. We're seeing long-term implications for some of the trends that we're seeing, for example, in healthcare, right? GLP-1 drugs, people are, we expect to see anywhere between 30 and 40 million people on those drugs in the next 5 years. So important to recognize that, yes, that has an impact on pharmaceuticals, but what are the downstream impacts to that? It's going to make a difference in the overall health profile of the U.S. population. People will be healthier, therefore maybe less surgeries, less medical equipment. We also think that has an impact on vials and syringes and the number of people that need those things to actually take those drugs at home. And then the last thing is the changing nature of the consumer taste. If you think about individuals who are on those drugs, who are eating differently, we think fast casual restaurants, Cava, Chipotle, Sweetgreen, these are companies that can pivot their menu options to appeal to those differentiated consumers. And remember, this is about 15% of the U.S. population that will be on these drugs in the next 5 years.
You know, it's amazing. You mentioned some of those companies, Sweetgreen in particular. Shares are up 215% year to date. You do see a lot of those names are what investors are embracing right now.
Yeah. To us, it's the downstream impacts of these big trends are important to think about. Another one is generative AI, right? We think about there's a bit of a J curve going on there. Generative AI, many companies are looking at that and saying, how can I turn this trend, this incredible technology, into a competitive advantage for my firm, right? And that's a big question. It's going to take a while to figure out. So that's a bit of the winter, the bit of the dip in the J curve that we're observing, certainly with companies. However, in the meantime, there's a significant source of capital expenditure in this area that we think investors should be paying attention to and taking advantage of. For example, Meta, Microsoft, Alphabet plan to spend $500 billion over the next 3 years on generative AI.
It is
half of that's to tech, half of that's going to other places like land and capital equipment and buildings and metals and mining stuff. Plumbers.
Really fascinating look at some of the narratives that are driving these companies and these sectors. Unfortunately, we have to leave it there. Hope to see you again soon. That, of course, is Maddi Dessner of the Capital Group. Now, coming up, we'll speak to Jeffrey Sherman. He is DoubleLine Deputy Chief Investment Officer. His thoughts on next week's Fed meeting. This is Bloomberg. Well, Wall Street's enthusiasm for mega-cap tech stocks continues to climb, with several Mag 7 stocks hitting new records this week. According to Bloomberg Intelligence, that's impacting their fair value model for the S&P 500. Let's talk about the case for equal weight, though, because joining us now is Jeffrey Sherman, DoubleLine Deputy Chief Investment Officer. And I'm so excited for this conversation because usually we talk about bonds with you, but today we're talking about this ETF from DoubleLine, the Fortune 500 Equal Weight ETF. You launched it in February, or rather late January, and it's doing pretty well versus its benchmark of the Equal Weight 500. But you think about the equal weight relative to the rest of the universe, the market cap weighted indexes out there, and it's just so hard to compete. What actually changes that?
Yeah, well, I mean, if you look at it, I mean, everyone's been professing about the concentration of the S&P 500 for really going on years now. And if you look at the top four stocks, it's over 23% of the index. You look at the tech sector alone, It's almost 33% of the index. And so we always profess diversification in this business, and people talk about indexing being a cheap way to do so. But the problem is that it may be cheap on a cost basis, but you're significantly paying up in terms of the multiple of earnings. And we just saw the CAPE ratio on the S&P 500 cross over 38 recently, which, it's rarely been in that territory through history. We see the trailing earnings over 30 times earnings on the S&P. And when you transition to something like the Fortune 500 equal weight, you get down to sub 20 on a multiple, which isn't inherently cheap by historical standards, but it is meaningfully cheaper than these mega cap weighted indices today. And so what you're finding is that there's this enthusiasm and jubilance of this new administration, tax cuts, all we hear about. But there's also the risks on the other side when we talk about the tariffs, the immigration policies and the like. And so the question one has to ask themselves is that, will this momentum continue in these markets? And do you really want to continue to make that bet? And so the way we've been talking to clients about thinking about their U.S. equity exposure is that there's nothing wrong with owning the mega cap. If you want 30% in mega cap and you want this tech sector, why not just go out and buy something? If you're an ETF investor, why not buy the Qs and do something else with the piece of your portfolio to ensure that you're getting a bit more diversification? And so we think things like the Fortune 500 equal weight, the DFVE product that we're running is something that can be very helpful in today's market.
Well, let's talk about the Fortune 500 index that you're using, because muscle memory, of course, we go to the S&P 500. Why go with this 500 stock index? And also the design of this ETF in particular, I believe you only have 460 of those stocks.
Yeah, so what it is that there's a lot of people, when you mention Fortune 500, a lot of people actually think it is the S&P 500 because of just that number being in both of those indices. But the difference between the S&P 500 and the Fortune 500 is the Fortune 500 is actually a rules-based process that's based upon revenue. And so it's looking at the U.S. companies, both public and private, that are domiciled in the U.S. So it's a U.S. kind of first type of idea, one. But secondly, it's using revenue as the criteria for inclusion. And so it simply just ranks them based on, their contribution to overall revenue in the U.S. economy. And so if you think about the S&P, it's one that's being judged by a committee. Nothing wrong with committees making decisions, but it isn't as rules-based as people think. And so there's this inclusion and exclusion mechanism that comes from some human judgment there. And so, again, nothing wrong with doing that. People have been doing that for many decades now. But what you find, because some of these companies are indeed public, you can think of something that, let's use SpaceX, for example, generates a lot of revenue, but it is not publicly traded. And thus, you can't invest in those in an ETF wrapper. And so from that standpoint, what we're doing is looking at these public stocks out there that have enough ability to trade them, have enough free float to be able to do so. And then we pursue an equally weighted methodology. So each year when the Fortune company releases its new list and the new 500 they did earlier this year, we reconstitute the index. We rebalance it on a quarterly basis to achieve these target weights so we don't end up with that concentration effect that we're talking about that riddles some of these other indices.
Jeff, I think of DoubleLine, I think of bonds. Are you branching out into equities? Are you going deeper into equities as the returns have just been so dazzling? I mean, we're looking at 25, 30% for the S&P 500 compared to, 9 or 10% for the best bonds.
Well, Matt, I know you think of us as a bond shop, but we have been running equity products for over a decade now. And so this is not something that's a new foray for us that we're trying to do Me Too or we're jealous of the equity market. It may shock you, but even as an investor, I own stocks as well. And so from that standpoint, when we find good ideas that we think are useful to our clients and things that we want to invest in, that's when we launch products in this space. And so we've had this methodology and we've had the exclusivity on it for a long period of time. But just given where multiples had been over the last couple of years, we decided that it was time to really launch a product like this, one. Secondly, with the development of our ETF platform, we thought it brings more diversity to the overall platform, and that's something that we really want to focus on. And so it's not that we're changing our stripes. This is something that we invest in stocks, we invest in bonds, And we continue to do so. And so, as you may have noticed, Matt, we just launched another ETF a couple of weeks ago in the bond space. And so our complex is now up to 7 ETFs under the DoubleLine brand. Plus, we have the 3 that we sub-advise under the State Street Spider brand as well. So we're just going where the market is asking for products from DoubleLine, and using our expertise and our ability to analyze markets is what brings us into this marketplace today.
Well, Jeff, rest assured, I am following what you're doing in the ETF space very closely. But in the time we have with you, I do want to get to the bond market proper. Of course, we're counting down to that Fed decision on Wednesday. Yep. Next week is the last week that actually matters in 2024. What are you expecting, and how does it filter through the Treasury curve in particular? That has been the epicenter of volatility in this market, and I'm wondering if that changes anytime soon.
I actually don't think it does change. I think the epicenter of volatility is the rates market. It will continue to be the rates market at least in early 2025. And so I know that a lot of people talk about the tightness of credit spreads out there, especially in the corporate bond market. And it makes a lot of sense given the deleveraging that's taken place in that part of the market, just the benign default probability today, given the earnings growth on that side as well. So when you look at the bond market, it hasn't corporate spreads or even credit spreads that have been volatile. It's really been the rate side. And I think that that's going to continue next year. So I heard your previous guest talking about, well, maybe the Fed isn't as accommodative, and we completely agree with that. I do think you get the cut next week. You'll get it on Wednesday. I'm really skeptical to see if we get any more cuts until kind of the back half of next year. And why that is that we still have to digest these new policies that are coming through. And so it's still to be determined on what the actual policy will look like when it comes to, the immigration side, when it comes to the tariffs. And is it bluster? Is it just negotiation, or is it factual? And I think that's going to be a big driver. Because, the flippant response is that, well, if there's tariffs, it causes inflation. But if it causes a lot of pain points, it could actually cause job losses, too. So it could be ultimately disinflationary and somewhat problematic to the overall economy. So I think with the jury's still out, we got another 38 days or so till we'll see the pen strokes come out on executive order. And then we're going to have to see how the corroboration is through Congress to see what actually does come through. And so I don't think there's some clear cut. I see a lot of people saying that, there's an obvious trade in today's market. I think the obvious trade is to be patient, enjoy the yields that the bond market's giving you. And if you get a little bit more of a rate backup, it makes bonds very attractive going into 2025, because we're talking about a stock market that's nearing, the high 20% gains for the year. And so it's going to require a little bit of rebalancing too. So all in all, I think rate volatility will continue at least in the first quarter or so until we get some more clarity on policies. But, the economy is still in a decent shape. It seems that thus far we've negotiated this soft landing. And so when I look at the bond market, there's real yields. That is, the yields are outstripping inflation, but inflation is still beyond the comfort level of the Fed, which means that it's probably not likely that you get a cut for the next few more meetings unless there is some really improvement in the inflation data.
All right, Jeff, it never feels like enough time, but it's great to get some time with you on this Friday. Appreciate you waking up early for us in California. That is Jeffrey Sherman of DoubleLine. This is Bloomberg. Well, in today's Big Take, we're focusing on a global trade worth billions: human eggs. India is a big part of the global fertility industry, and often its price is extracted on impoverished women who are desperate to survive.
All my husband does is get drunk and sleep. My kids and I won't be able to eat. We've also considered killing ourselves. Sumathi took me to a clinic in Vadalur. I was too weak to donate enough blood, so I said eggs.
The Dalits are among the most marginalized groups within the Indian caste system, often deprived of quality education and jobs.
All of us women are sanitary workers. I'll get 450 rupees a day. 100 rupees go toward our food.
But these women carry something more valuable than anything among their family's modest possessions: their fertility. It's an open secret that she is the fertility agent. She's a cog in a sprawling network of agents and go-betweens across the country. profiting from the sale of human eggs. Every 15 seconds or so, human eggs are taken from a woman somewhere on the planet to satisfy the global demand for assisted reproduction. Advocates warn that India's poorest women are at the mercy of an industry that preys on the most vulnerable. For Sumati and the other women in her village, the people who make the laws feel worlds away.
Sometimes we do regret donating ovarian eggs out of haste for the sake of debt relief.
All right, that was Bloomberg's big take on the global fertility market. You can read more in Bloomberg Business Week. It's out on shelves now, but let's get a check on these markets. We're almost an hour into the trading day. Of course, as we've been talking about, set to end on a positive note for a down week, but you can see those gains coming back a little bit right now. The S&P 500 only higher by about 0.1%. We had been higher to the tune of about 0.3% a little bit earlier, but again, paring back our gains. It's the same story on the NASDAQ 100. Even with that big gain that you're seeing in Broadcom, the NASDAQ 100 still up by a pretty good margin here, but coming back a little bit. And then the 10-year yield, that quiet climb in yields continues. The 10-year Treasury yield higher by about 4 basis points, Matt Miller.
Yeah, I think that's pretty interesting. You know, we were looking at 10-year yield under 420 and saying it's holding there and not really caring much. And every day it was adding a few basis points. And now we're getting closer and closer to 450.
And Jeff Sherman just told us more volatility to come in the rates market. So get used to it. Coming up, the diamond industry is in trouble as lab-grown gems tank prices. We'll speak about it next. This is Bloomberg.
The rise of lab-grown diamonds is disrupting the jewelry industry. De Beers, the world's largest diamond producer, had to cut prices by more than 10% across the board, and the industry has been struck by one of its deepest and most prolonged slumps in decades. For more on the future of that industry, we're joined by Ankur Daga, Angara CEO. Ankur, great to have you on the program. We've spoken before, and I have not stopped thinking about our conversation or talking about our conversation since you joined. So lab-grown diamonds apparently are so good now. If I took one into Tiffany, for example, right here on Fifth Avenue, do you think the jeweler at the counter would be able to tell me if it was lab-grown or real?
With the naked eye, you cannot tell the difference. They're chemically, physically, optically identical.
What about with one of those loops that they wear?
Under a 30X, under a 10X, you could not tell the difference. The only way you could is there's specific testing equipment. So either you send it to the GIA, IGI, or in a jewelry store, they do have testing equipment that can tell the difference. But very small nuances. So for example, one is nitrogen-free, which is the lab-grown, and the other has some trace elements of nitrogen. But to the naked eye, you cannot tell the difference.
Can we talk about the quality scale, though, and if it exists? Because this is mean, but there's Facebook groups that are dedicated to calling out, like, poorly made lab-grown diamonds, moissanite, for example. I feel like you can tell with certain diamonds.
Yeah, so moissanite is not a diamond, and you can certainly tell with the trained eye. But with the lab-grown diamonds, they're chemically, physically, optically identical, so there's actually no fundamental difference. And they're cut and polished by hand the same way a natural diamond is, so they look identical.
So what are you selling? Are you selling the real deal? Are you selling lab-grown? Do you have a mix?
We're selling both. We launched lab-grown 15 months ago. So on the same product page, we'll offer the same design in both lab-grown and natural.
What's the price difference, say, of a 2-carat,
10X. For the actual diamond part of it, 10X. Yeah, so a 3-carat engagement ring, for example, would be $30,000 if it's natural. It'd be $3,000 if it's lab.
That's fascinating. Do you see those prices converging, though? Because I think about other luxury items, and I hear what you're saying, the research out there that it's much cheaper to produce these lab-grown diamonds. But you think about, luxury handbags, for example. They don't have that high markup because they were expensive to make necessarily. It's just because people want it, and there's a ton of demand, and there's this mystique about it. So do you see that happening with lab-grown diamonds as well?
I think on the lab-grown side, the prices have stabilized. So 2018, they were roughly 15% cheaper than the natural equivalent. Now they're 90% cheaper. They're not going to get cheaper from here, most likely. Diamond prices, however, natural diamond prices have been coming down dramatically.
Yeah.
So versus peak, they're down 50%. In the last 12 months, they're down 23%. Pretty amazing. And as you mentioned at the beginning, De Beers dropping prices by 10%. They're still high. So a site holder, which is a direct customer of De Beers, who's buying that parcel of rough, is still losing money. So there needs to be another 15 to 20% correction before the market starts stabilizing. So we're going to continue to see that.
I mean, I imagine the only reason you'd want a real diamond versus a lab-grown diamond is for the value of it. Since you can't see the difference, you can't tell, you won't know, right?
Yeah.
I guess the only reason that you would want a real diamond is to hold the value, but as it drops, that reason becomes
moot.
Yeah.
I mean, historically, there's two reasons people bought natural diamonds. One is this inflation hedge because it starts appreciating over time. And two, there's financial flex. So if you're wearing a 2-carat or 3-carat ring, it's showing, it's telling you something about yourself. With lab-grown being 90% cheaper, the financial flex goes away. With diamonds going down in price, the investment thesis goes away.
And there's not a market, as with gold and silver or copper, right? These are traded and we have spot prices in different markets. You don't have the same thing with diamonds.
You can easily resell it, but not nearly as easily as gold. Yeah. Correct. Yeah.
I do want to move on from diamonds because I'm looking through your notes. You also talk about colored gemstone engagement rings, which, in the nasty Facebook groups I'm a part of, they get a lot of heat as well.
But they don't like emeralds or sapphires?
No.
They don't like rubies?
No.
In engagement rings?
No.
What Facebook group is this?
I don't know. It's this nasty group I joined like 3 years ago. In any case, not that is real data here, but you are seeing more engagement with colored gemstones. I feel like they are becoming more popular. What are you seeing trend-wise there?
Yeah, they're growing very quickly. So historically, let's say 10 years ago, they were 5% of the engagement ring market. They're already crossing 15% towards 30%. So we ran a nationwide survey 6 months ago, and 30% of Gen Z soon-to-be brides would prefer a colored gemstone. So we're seeing that dramatic shift.
I feel old.
So
I can't relate to
They're
it.
not in your Facebook group.
No,
you might need to look at Snap or
TikTok. They don't even
TikTok.
have Facebook accounts, probably.
I wonder. I don't want to move too far away from the diamond comparison because I find it so fascinating. And now that you've been selling lab-grown diamonds for 15 months, what's the mix look like for you, and what's the trajectory?
It's been tremendous. So on the diamond side, the same SKU is now 60% lab, 40% natural, where it used to be 100% 16 months ago. So the majority are choosing lab. On the color side, it's roughly 2/3 natural, 1/3 lab, but even that's growing very quickly as well.
So as Katie and her compatriots die out or get married, the younger generation is going to be choosing
lab grown. Yeah. So it's interesting. So
the more sustainable option, I was going to say.
Is more sustainable and much cheaper. So affordability is obviously very big, but in the survey that we ran, the #1 criteria for women was affordability. So now, under $5,000, you can get a 2 to 3 carat diamond engagement ring. That used to be the dream for decades, and that used to be $30,000, so you out of reach.
Yeah.
Now a lot of people can afford that.
I also am always curious, thinking about the jewelry business, specifically the diamond business, you're pretty closely tied to engagements. And I don't know if there's any cyclicality or seasonality there, but how do you think about that from a business approach, branching out of just, engagement rings?
So 37% of the engagement rings sold during the year are sold between November and February. So this is certainly...
There is a cyclicality.
There is.
That's interesting.
So Valentine's Day is in that, Christmas Eve is in that. But I think the larger opportunity that the lab presents is that there's 62 million married couples in the U.S. There's 2.5 million engagements that happen every year. So the market for people that are already married that can now afford a lab-grown ring that is 2 to 3 carats, which is what they've always wanted but couldn't afford, is 25x the regular engagement ring market. And I think that's the market that will expand. So, broadly speaking, the overall jewelry industry worldwide is roughly $370 billion. I think it gets to $1 trillion in a decade, which is 10% per year growth. Everybody else is predicting 4%. And it's because people can now start affording what they haven't been able to purchase in the past.
So there's an upgrade cycle, is what you're saying.
Precisely.
Not only that, but
Yeah.
there's an anniversary. How long have you and Joe been married?
Forever, 7 years.
Okay, at 60 years,
Yeah.
that's the diamond anniversary.
Interesting.
So you can expect another rock.
All right.
And then again at 75 years, according to
Not so
Google
far away.
AI. Yeah.
You know, just got to hang in there.
Yeah. Ankur, thanks so much for joining us. I always find it really, really fascinating topic. So it's great to see your data as you get more of it. Angara is the company. Check it out. Let's get a check right now on what's going on in the markets. For that, we go over to Bloomberg's Abigail Doolittle. Abby, what do you got?
Well, on the day, smaller moves, but let's check out the week because we are looking at mixed moves for the S&P 500, NASDAQ 100, and Russell 2000. The S&P 500 right now on the week down about 0.6%, the first time we've seen this in a few weeks. The NASDAQ 100, on the other hand, higher, really being helped out by today's Broadcom rally and chips, up about 0.7%, up for a fourth week in a row. And then the big loser, Russell 2000, those small caps that you all have been talking about this morning, down for a second week in a row. And this is the worst week in about a month. So again, mixed moves here. One thing, though, that stands out across the board for all of these indexes through cap size and style size is volatility. There's not a lot of it. Complacency. We'll check this out looking at the VIX, which over the last few days, the month of December specifically, it looks like we have moves here, but look at where we are. Sub 14, we have a 13 handle. So big, small moves, if you want to put that in some sort of a context there, within a very small range. Investors complacent, some worried that this complacency could signal some sort of storm or at least consolidation ahead, including Steve Sosnick over at Interactive Brokers, who has pointed out that skew index, that panic index is high. Scott Bauer of Prosper Trading Academy also saying investors are complacent. Let's connect this with the S&P 500 because there is reason technically to think that at some point next year, this big rally, right now the S&P 500 up more than 25%, could in fact correct to some degree. So here is a rising range you can see for the S&P 500. As it tightens, that tells you that the investors are a little bit less enthusiastic. The price is tighter. You can also see that the RSI is at a lower level than it was when the S&P 500 was at a much lower level. That's a bearish divergence. All of this, Katie, suggests that at some point in 2025, who knows on timing, that there could again be some consolidation or maybe an outright correction down toward where this big election rally in particular, or out of the summer too, really started off.
Yeah, and that would certainly wake up the VIX. Abigail Doolittle, thank you so much. Now, coming up, the future at the FDIC. Former Chair Sheila Bair discusses how President-elect Donald Trump could impact financial regulation. This is Bloomberg. All right, it's time for our daily Wall Street Week conversation. And President-elect Donald Trump is putting together a new team to manage the financial industry over the next 4 years. David Weston spoke to former FDIC Chair Sheila Bair about the impact on the banking system.
I think that there will be a significant change there. Both the FDIC and the OCC, particularly my former agency, and this is one area where I really did not agree with the direction they were going. They were really trying to essentially chill any bank M&A activity that would result in a bank larger than $100 billion. And I think that's just not the right approach. In times of turmoil, I mean, some level of bank consolidation activity is healthy. And we have such huge concentrations with the very largest multi-trillion-dollar institutions. To hamstring these smaller institutions from getting a little bigger to compete with them, that just creates a deeper competitive moat around these very, very large mega banks. So I do think, healthy M&A can be healthy. I think there's going to be a change in direction with that. Again, both the leadership of the FDIC and the OCC will change when Mr. Trump, or it's his right to change the leadership when he comes in. And I can only assume they will be friendlier to bank M&A, at least at the community bank and regional bank level. Now, for the very largest banks, no, I don't think anybody wants them to get a lot bigger. So I think there are legal constraints against the mega banks getting any bigger because of their huge percentage of their deposit base that they account for. So I don't think that'll change. But at the community bank and regional bank level, I do think there will be much more sympathy for consolidation.
Another agency is the CFPB. an agency that during the first Trump administration didn't get a lot of love, I think it's fair to say. There was a fair amount of criticism. It's done a bit better under President Biden. What are we looking at under the second version of President Trump?
Yeah. Well, actually, I think Kathy Kraninger was the head of the CFPB under Mr. Trump, and I think she did a fairly good job, actually. I know she wasn't as proactive as a lot of consumer advocates wanted, but she did a pretty good rulemaking to provide better consumer protections against aggressive debt collection tactics, brought a lot of enforcement cases under her. So I think, it wasn't bad under Trump 1. I think, she was a good steward of the agency. Again, not as robust as some might have liked, but I thought she did a pretty good job. So I don't know why Elon Musk is targeting this tiny agency. It's less than $700 million, the budget, that's nothing. In the scheme of it was a $6.75 trillion federal budget, something that's, $700 million. You're not going to save any money, even if you eliminate it, which you can't because Congress created it. And the funding actually comes from the Fed. It's not appropriated. So even if you had authority to impound those funds, you couldn't do it. It's coming from the Fed. It's not coming from congressional appropriations. And, the constituency for the CFPB is Mr. Trump's sweet spot, working families. That's who the CFPB is, mandated to serve and protect. And you may have different views about the best way to protect them in the financial services area, but those are the powers of the CFPB.
And that was Sheila Bair in conversation with David Weston, who joins us now. And David, a really interesting conversation. And it was interesting to hear what she was saying about the small, the mid-sized banks. Lines up with a lot of what we've been hearing, that we could see a lot of consolidation there.
Yeah, and some authorities, people like Dan Tarullo, who's not thought of as being particularly on the right side at all, has said for some time there should be consolidation at the regional bank level, actually, to make it stronger. In part because the really big banks have been getting so much bigger. JP Morgan has gotten so much bigger. You have to have some sort of an alternative to that. So there are various people who think that would make sense, and it looks like that's increasingly likely. She said at the beginning there a lot of changes to the FDIC. Wall Street Journal today said one big change may be just eliminating it, although they'd have to have that function somewhere else, and Congress would have to pass on that.
And by the way, she was head of the FDC at a time when Americans were really concerned about bank deposits when we really needed the FDIC. We haven't for a solid 15 years now. So is it fair to say that regulation gets a little bit more lax when we don't need it for a long time?
Well, we did need it with Silicon Valley
SVB?
Bank, didn't we? Remember that we had 3 or 4 bank failures there that they had to step into. And one thing she talks about, actually, is that during that time they had emergency approval to insure deposits, particularly of smaller businesses that have to meet payroll. And she thinks that one change should be made is to give them that authority ongoing when there's a bank crisis to really step in and guarantee more deposits. So we did need them then. And as you say, during the great financial crisis, she was part of the team with Hank Paulson, to really sort of put the thing back together.
Well, let's talk a little bit, too, about Basel III Endgame, of course. Some comments there as well. What's her take?
She thinks it's dead.
Yeah.
If not dead, it'll just be substantially gutted. You remember, they came up with a really stringent set of regulations. The banking industry went nuts, I think it's fair to say, a technical term, and said, we can't do that. So they drew them back, and they came out with more moderate ones. But she says she thinks the whole thing was very confusing anyway, but she thinks, given the fact you have to have approval of both the head, the OCC and the FDIC, that whoever Donald Trump appoints will probably say, forget it, we're not going there.
It strikes me, we haven't spoken since the game.
What game?
Oh, I know what game it is. I'll have a view on this. We were talking about the only game, Michigan versus Ohio State.
Okay, all right.
Or he would say Ohio State versus Michigan.
I'll just roll back
in which Ohio State was supposed to run away. I thought they were going to run away, and Michigan won the game.
Double digits.
A great victory for the Maize and Blue, but I was really appalled at the conduct of my team, Michigan, after the game was over, when they tried to plant that flag. We expect that, no offense, we expect that of Ohio State. We don't expect that of Michigan. Michigan doesn't behave that way.
Well, we expect it of Ohio State, too. We're not offended. Congratulations on the win, David.
All right.
Looking forward to Wall Street Week.
Yeah, that is at Friday, 6 p.m. Today, actually, you can catch it with David Weston. This is Bloomberg. Well, Bloomberg held its flagship ETF event in New York yesterday. We had speakers like Tom Lee of Fundstrat. We also had Nouriel Roubini, of course, discussing the growth and the opportunities in the industry, which has just been on fire. Joining us now is Eric Balchunas. He is Bloomberg Intelligence senior ETF analyst who really ran the whole show. And Eric, it was interesting, of course, the sequencing, starting with Tom Lee, a noted bull, and then ending with Nouriel Roubini, who's known as Dr. Doom.
Yeah, no, quite the juxtaposition. Maybe next year we'll have them together for the debate to end all debates. But Tom Lee is very bullish, very optimistic. And then Roubini, on the other hand, came in and painted a pretty grim picture. He thinks that inflation is coming because we're going to have to fight all of these different wars against, countries, climate change, societal unrest. It was quite the picture. And of course, if you have inflation, your 60 and your 40 both go down. Well, what goes up? The stuff that's in his ETF.
Yeah.
So he was sort of making the long case for his fund. So he's putting his money where his mouth is. He said his whole life he just talked about stuff and wanted to finally put it into a fund where he could manage money for real. And this ETF is that. So they both also filed around the same day. So they're interesting. Their paths are totally different, but the same.
Yeah, it is really interesting. And I like he's now walking the walk as well. I want to talk a little bit more about Tom Lee. Of course, he recently launched an ETF last month. It's the Granny Shots ETF. I spoke to him and he said that it's active, but it's rules-based, and basically their stocks have to be in an important index. And he said to me, if MicroStrategy is added to the NASDAQ 100, they would buy it. I know that you have thoughts on whether or not that will actually happen, whether MicroStrategy actually will be included in that index.
Yeah, my colleague James Safer did. I'll give him the credit for all the legwork. But to summarize, it should be added. If you want to believe indexes have rules and they follow those rules, it should be added, announced at 8 p.m. tonight. There's a small chance it won't. Some people are talking about ICB is going to do a last-minute reclassification of the stock out of a tech sector into financials. But I haven't heard anything, and we're at the 11th hour, so it looks good. We'll see. In terms of Tom Lee, it's funny that ETF is called Granny Shots. I love that metaphor. When you shoot a basketball underhand free throw, your rate goes up a lot versus the NBA guys who shoot it like a regular shot because they don't want to look like dorky. It's a great metaphor for his fun. That said, MicroStrategy isn't the most granny shot stock, I would think, but he did kind of go into that. You pressed him on that, and I thought it was a great interview.
Well, thank you, Eric. This is what we do on ETF IQ. We just compliment each other. Eric Balchunas of Bloomberg Intelligence. Have a great weekend when you get there. And tune in to ETF IQ Mondays at 12 p.m. Eastern. You can also sign up for the ETF IQ newsletter that comes out Fridays at 2 p.m. once I write it. But anyway, we have some breaking news here, Matt, and it's that a large study finds that Novo Nordisk's blockbuster shot Ozempic is linked to an increased risk of a rare form of vision loss. Really interesting, of course. There has been a lot of concern about potential side effects for all of these blockbuster weight loss drugs. You take a look at Novo shares right now. They're lower on the day. They were already having a down day, but Matt, currently down about 3.7%.
All right, we're talking about a vision loss, a rare condition called Naion, N-A-I-O-N. Apparently it occurs when a loss of blood flow damages the optic nerve and is most common in people older than 50. That means me. Yeah. I think I would still roll the dice.
I don't know. I mean, that's a risk-reward analysis that I think a lot of people are taking. But in any case, we'll continue to follow this story and everything else in these markets, because you take a look right now at the S&P 500, of course, as we count down to the end of the trading day. If we show it, that would be interesting. Yeah, the S&P 500. We had been looking at gains earlier on the day, but currently right now, you can see we flipped into the red. So interesting stuff there.
Yeah,
off the next 2 weeks.
Absolutely. I'm off. Have a great vacation, and all of you enjoy Katie and Sonali. This is Bloomberg.